So if you give the average person a mutual fund that consistently generates a 10% return over a decade, they will almost always end up with less than 10% in their own account.
Right. Sometimes a lot less, actually.
Yeah, and it's wild because the fund does its job perfectly, right? The market behaves exactly as expected, and yet the money just kind of vanishes.
That's a huge problem.
It really is. So today we are pulling apart a fascinating piece of financial analysis called The Investor's Temperament: Surviving the Market's Worst Days. And our mission for you listening today is to figure out why that money disappears and what actually determines your long-term investing success.
And spoiler alert, it has almost nothing to do with finding the perfect stock.
Right. Nothing at all.
The author of this analysis actually sets up a really brilliant control group to prove this point. They strip away all the usual variables, luck, timing, inheritances, just to isolate the one thing that actually matters.
Okay, let's unpack this setup. What's the experiment?
So they ask us to look at 3 hypothetical investors. We have Angel, Quinn, and Theo.
Okay, Angel, Quinn, and Theo.
Right. And they are the exact same age, making the exact same salary. Nobody gets a surprise bonus or like a windfall from a rich uncle. So
they're starting on completely equal footing.
Exactly. On the exact same afternoon, they each open a brokerage account and invest exactly $10,000. From that moment on, the only difference in their financial trajectory is which 3 ticker symbols they type into the search bar.
Wow, okay.
They essentially represent the 3 fundamental archetypes of investing. So Angel goes with the Vanguard S&P 500 fund. Let's call her approach the market.
Okay, so she's just buying the baseline American economy.
Yes.
And because we are talking about a broad index fund, her fee on that $10,000 is something microscopic, right? Like 0.03%.
Right, yeah. She's paying maybe $3 a year to hold a cross-section of the entire market.
That's incredibly cheap. Very low friction.
Extremely low. Then we have Quinn. Quinn decides to buy a Nasdaq U100 fund, which we'll call the bet.
The bet. Okay, so what's in that?
It's heavily concentrated in massive technology companies. Your NVIDIA, Apple, Microsoft. It's a very aggressive, confident play on the future of tech.
And I'm guessing the fee is a bit higher for that.
It is, yeah, around 0.18%, meaning it's 6 times more expensive than Angel's fund, but it's still pretty cheap in the grand scheme of things.
Right, still under 1%. And finally, we have Theo.
Yes, Theo. Let's call his strategy the checks. He buys a dividend fund filled with these incredibly dependable but unglamorous companies.
Like what?
Think factories, toothpaste manufacturers, utility, companies that routinely pay out a portion of their profits in cash.
Right. Boring but stable.
Exactly. His fund yields about 3.3%, meaning Theo is getting roughly $330 in literal cash his first year just for showing up.
Okay, so 3 approaches to the exact same goal: the baseline market, the aggressive tech bet, and the conservative cash yield.
That's the setup.
It's almost like they all walked into a casino with 10 grand. Angel walks up and essentially bets on the house itself.
Right. Quinn finds the loudest, flashiest slot machine in the room and puts it all on a jackpot.
Yeah, a great way to put it.
And then Theo basically invests his money in the casino's ATM machine and just collects the transaction fees.
I love the ATM analogy for Theo. But, there is a catch with that strategy. Like, what happens when inflation eventually raises the cost of maintaining that ATM?
Oh, right.
We will definitely get to that structural weakness later. But the real hook for this entire deep dive is looking at the 30-year finish line for these 3. Because the ultimate winner isn't decided by who picked the best ticker symbol. No. It is decided by a massive psychological trap that costs the average investor tens of thousands of dollars.
Okay, but since that trap doesn't snap shut on day one, we really need to look at how these 3 investments actually feel to live with in the short term, right?
Because the source material spends a lot of time on the social and emotional weight of investing, which I find fascinating. It sets up the dangerous illusions of early success. Let's look at the emotional scoreboard for the first 3 years. Picture Angel, Quinn, and Theo at a dinner party.
Right, because investing is an inherently social behavior. We compare notes. And at a dinner party during a bull market, Quinn is going to be the center of attention.
Oh, for sure.
The tech sector is known for these massive, violent upward swings. Quinn is riding those highs, pulling up charts on a phone, telling this wild story about rapid wealth accumulation. The analysis describes this specific energy as someone who has confused a hot market for a personal character trait.
That is such a great line. Meanwhile, Angel has absolutely nothing exciting to say.
Nothing at all.
She bought the broader market, her fund performed exactly average by definition, and that just makes for terrible dinner party banter. She just sits there eating her salad.
Yeah, pretty much.
And then there's Theo, who is quietly taking his boring $330 in dividends and just reinvesting them. Literally nobody in human history has ever bragged about a 3.3% dividend yield at a party.
No, they definitely haven't. So the short-term emotional scoreboard heavily favors Quinn. If we map out the tempered, historical long-run rates, the source uses, say, a 10% return for the broader market, a hotter 12% for the tech bet, and 9% for the dividend fund by year 3, Quinn is visibly and smugly ahead.
Let me guess the math.
Go for it.
Quinn's tech bet sits at roughly $14,000. The market is around $13,300, and the checks are trailing at $12,900.
Spot on.
Okay, but wait. So I'm looking at this napkin math, and honestly, it's hard to argue with Quinn's approach. In the real world, over the last decade, tech didn't just do 12%. Some of these funds were hitting closer to 22% a year.
You were, yeah.
If I extrapolate 22% out over 30 years, $10,000 turns into an obscene $3.7 million. If the math works on a calculator, why shouldn't you just chase the 22%? Who cares if you sound smug at a dinner party if it makes you a multimillionaire?
Well, what's fascinating here is that napkin math assumes the future is a smooth, unbroken line. And the source provides a brutal historical reality check on that specific 22% number.
Okay, lay it on me.
It is not a law of physics. It is a hot streak. If we look back to the dot-com crash of the early 2000s, that exact same profile of tech-heavy fund fell by more than 80%.
80%.
Yes. And the recovery wasn't a quick bounce. It took over 15 years just to get back to the starting line.
Wow.
Imagine your $10,000 drops at $2,000. You have to wait a decade and a half just to see $10,000 again. No fund compounds at 22% smoothly for 3 decades. The math looks incredible on a calculator right up until it collides with human psychology during an actual decade of market turbulence.
Which perfectly sets up the core conflict in the source material, really. This disconnect between a spreadsheet and a human nervous system. Let's fast forward our scenario to year 10.
Okay, by year 10, the inevitable happens. The market experiences a completely ordinary, historically standard pullback.
A crash.
Right. And the tech sector, being more volatile, takes a 35% hit.
Okay, so Quinn's tech fund, which was doing great and maybe sitting at $30,000, just plummets to $19,500. $10,500 evaporates in the time it takes to refresh an app.
It's terrifying.
Think about your own retirement account right now. If you logged in tomorrow morning and saw a third of your life savings just completely gone, what is your immediate physical reaction?
It's visceral, right? It's a complete fight or flight response. The neurological pain of losing money registers in the brain incredibly similarly to physical pain.
That makes total sense.
Now, contrast Quinn's panic with Theo's mourning. While Quinn is staring at a screen bleeding red, Theo's boring 3-figure dividend check lands in his account right on schedule.
Oh, that's wild. The broader market feels like a burning building, but the toothpaste company still sold toothpaste, so they still paid their dividend.
Exactly. Theo barely looks up from his coffee.
And this is where we hit the most critical data point in the entire text, because Quinn is now facing a massive psychological test, and the statistics show that most people fail it.
They absolutely do. The analysis cites a recurring study called Mind the Gap. It basically measures the difference between what investment funds actually return on paper versus the real-world returns that the human beings holding those funds actually experience.
The behavior gap.
Right. Over the 10 years ending in 2024, the average investor trailed their own funds by about 1.2% a year. They surrendered roughly 15% of their potential gains.
Wait, let's break down the mechanics of how that actually happens. The fund itself made the money, so how does the person holding the fund not make the money?
Because they don't just hold it. The mechanism of the behavior gap is entirely driven by flinching. Yes. When Quinn watches 35% of his wealth vanish, the physical anxiety becomes intolerable. So near the absolute bottom of the market crash, when prices are at their absolute cheapest, he hits the sell button just to make the emotional pain stop.
Wow. So he essentially pays a panic tax. He converts a temporary paper loss into a permanent locked-in cash loss.
Exactly. And then he waits for things to, feel safe again before buying back in.
Which means he gets overly hopeful at the top and buys back in when it's expensive.
Right. He misses the steep, rapid recovery that usually follows a crash. That friction, that constant jumping in and out of fear and relief, that is the panic tax.
And the text puts a staggering dollar amount on this panic tax. Dragged across 30 years, that tiny 1.2% behavioral gap quietly cost the average investor $49,000.
It's massive.
Almost 50 grand. Not lost to the crash itself, but lost to the human act of trying to dodge the crash.
Furthermore, the more volatile the fund, the wider that behavior gap becomes. People holding calm, boring funds lost far less to panic. But people holding exciting, wild funds, like Quinn's tech bet, they cost themselves nearly double that gap because the swings were so violent, they simply couldn't stomach the ride.
Okay, so Quinn is clearly taking a beating emotionally and financially. But if Quinn's strategy is a heart attack waiting to happen, why doesn't everyone just do what Angel did? Buy the broad market, ignore the tech volatility, and cruise?
Well, because Angel's strategy has a massive hidden flaw that the source material exposes.
Yeah.
Every approach has a shadow side.
Okay, let's expose them. What's wrong with Angel's S&P 500 fund? She thinks it's the ultimate impenetrable shield of diversification, right? 500 different companies across the whole economy.
Right, but it's actually fake diversification.
Fake diversification.
Yes. We have to look at the mechanics of market cap weighting. The S&P 500 is not 500 equal slices. The biggest companies take up the most space in the fund.
Oh, I see.
So a massive chunk of Angel's money is actually riding on the exact same handful of giant tech companies that dominate Quinn's fund. If those top 5 or 6 tech giants stumble, they drag Angel's supposedly safe portfolio down with them.
Oh, wow. So she thinks she has zero concentrated tech risk because she bought the market, but she actually has a ton of it. It's the most dangerous kind of risk, the kind you are absolutely certain you don't have, so you aren't mentally prepared when it hits.
Exactly. And then we have Quinn's flaw, which we just discussed, the nervous system tax. A fund that drops 35% is only good if you are a robot. Most people cannot watch a third of their net worth evaporate and feel nothing.
Right. And what about Theo? He slept wonderfully during the crash.
True, but the price of safety is exorbitant. Over those 10 years, he made significantly less money than the other two because his companies prioritize paying out cash today rather than reinvesting in massive growth for tomorrow.
Opportunity cost is a real cost.
Safety isn't free.
It really isn't. It costs you the gains you missed out on. Add to that, the expert introduces 2 silent killers that prey on all 3 of these strategies, and they do it so quietly you almost don't notice until it's too late. Inflation and fees.
Yes, let's start with inflation, going back to your ATM analogy for Theo. We discussed a historical 10% market return. But the underlying mechanism of inflation means the cost of goods is constantly rising.
Right.
So once inflation takes its cut, your real return, your actual purchasing power, is closer to 7%. Inflation never sends a bill, but it quietly erodes the foundation of Angel, Quinn, and Theo equally.
And then there are the fees. This part blew my mind. Let's look at the actual mechanism of compounding fees. Remember Angel's $3 fee versus Quinn's slightly higher fee? Early on, the difference is negligible, just a few bucks.
Right.
But stretched across 30 years, Quinn's 0.18% fee ends up costing him $7,000 more than Angel's.
And we really have to explain why that happens. It is not just that Quinn is paying a slightly higher fee every year. It is that the money used to pay that fee is permanently removed from his account.
So it can no longer grow.
Exactly. He loses the money to the fee, and he loses the 30 years of compound interest that money would have generated.
And here is the absolute kicker from the source. If any of them had wandered into a typical traditional mutual fund charging a 1% management fee, which, sounds tiny, that single lazy decision would have eaten $40,000 over 30 years.
It's devastating. The fee you barely notice in year 1 is mathematically guaranteed to do catastrophic damage by year 30.
So what does this all mean? If Angel isn't actually diversified and Quinn's portfolio is a heart attack waiting to happen and Theo is missing out on growth, how are you actually supposed to win this game?
Well, to answer that, we finally have to look at the grand finale of the source material, the 30-year finish line. This is where the analysis reveals a shocking twist about how to actually survive the market.
Okay, let's run the pure cartoonish math at year 30. Assuming, and this is a heroic assumption, that all 3 of them held on tight, never flinched, and never sold a single share. At year 30, Angel the market has about $174,000. Theo the checks has roughly $133,000. And Quinn the Bet has a massive $300,000.
Right, so looking purely at the spreadsheet, Quinn destroyed the competition. The aggressive tech bet wins.
But that is the ultimate trap of financial planning. Quinn only wins on a spreadsheet.
Exactly.
In an actual messy human life, Quinn is the least likely person to actually achieve that $300,000 number. Because getting there requires holding through multiple 35% crashes, terrifying recessions, and global panics for 3 decades without ever hitting that sell button at 3 a.m. when everything feels like it's collapsing.
And spreadsheets do not have nervous systems. You do. A portfolio that looks optimal on paper is totally useless if you abandon it at the bottom of a crash.
Which brings us to the ultimate insight of the text. There was a secret 4th choice available to them the exact day they opened their accounts.
Ooh, the secret 4th choice, splitting the difference. Yes, taking that $10,000 and blending it. A piece of the broader market, a piece of the aggressive bet, and a piece of the dependable checks. And then executing the single hardest maneuver in all of finance, doing absolutely nothing.
I love this because the blend doesn't win because it has the highest mathematical return, right? We already know Quinn's strategy has a higher ceiling, so why does the blend actually work better for a human being?
Because of how it behaves on your worst day.
Yeah.
It is basically an act of behavioral engineering.
How so?
Well, when the inevitable crash comes, the tech portion of your portfolio will bleed, sure. But Theo's dividend checks will keep landing in your account, providing this crucial psychological comfort. And Angel's broad market holdings will stabilize the middle.
So the overall drop in your blended portfolio is significantly smaller and less violent than Quinn's terrifying plunge.
Exactly. It physically prevents the 3 a.m. panic sell. You don't build a portfolio to maximize a theoretical spreadsheet. You build a portfolio that a highly emotional, loss-averse human being can actually endure when the market is on fire.
The winning strategy isn't about hunting down the mathematically highest return. It is entirely about building a psychological system that minimizes your behavioral friction.
That's the whole secret right there.
That is a massive paradigm shift. So let's summarize the core takeaway for you listening right now. The next time you're at a Thanksgiving dinner or you hear a podcast pundit passionately pitching the absolute best index fund to buy, do not argue with them about the ticker symbol.
Right. Ask them about the hidden mechanics. Ask what the return looks like after fees. Ask how it survives inflation.
But most importantly, ask them if they have a plan to survive a 35% drop without panic selling.
Because if they don't, the math doesn't matter.
Yeah.
And this actually leaves us with a really provocative final thought to mull over. Something that builds on this whole focus on investor psychology.
Oh, what's that?
We spend so much time optimizing our spreadsheets. But what if the most profitable financial skill you can develop isn't reading charts, but rather mastering your own emotional triggers?
Wow.
Especially now as we enter this era of automated robo-advisors, where AI manages the asset allocation. It forces us to wonder, will this human behavior gap finally disappear? Or will we just invent new, highly automated ways to panic when the algorithm does something we don't understand?
That is a deeply unsettling thought. If the biggest leak in your bank account is you, maybe the best investment you can make today is simply learning how to sit on your hands. This deep dive. Keep questioning the spreadsheets, examine your own panic triggers, and we'll see you next time.